for the indices stopped functioning, but it looks like it's corrected now. Everything's back to normal. But ask us anything. KV, I'm back. It's been a while. So these sessions are always interesting. Ask anything you want. We'll answer it to the best of our ability and within the framework of our role. Any questions like, what do you think the market's going to do? Those types of things. Number one, if I knew that for sure, I would tell you, and I'd also be a billionaire. So we'll try to stick to things that have factual answers as best we can. But KV, good to see you. Why don't you get us started, pal?
Great to see you as well, Rob. Hey, by the way, when you do figure it out, don't forget that I've been your friend for a very long time. Welcome in, everybody. A few disclosures on the screen. We certainly see quite a few questions already. Appreciate that very much. And again, these sessions are always dependent on the crowd that we have in here, right? The more you ask, the different the more variety, the more interesting I think these sessions do get. Quick first question from an anonymous attendee. I mean, could have come from anyone really, right? But when you're thinking about reconfiguring your portfolio, having multiple accounts, what trading priorities should be applied in up market as now versus down market? And is there any particular special order? Well, first, I think it would be very important to recognize what reconfiguring means. I mean, are you looking to start with a clean slate, meaning you are getting out of everything you have at the moment, going all full cash, and then redistributing, according to a new strategy that you have? Or are you just trying to kind of rebalance, right, or restructure portions of what you got going on? So, Rob, what I would say if I had to do something like that, and this is a vast question, but if I had to do something like that, I would definitely start with the analysis tab on Fidelity.com, knowing exactly what I currently have in terms of my sector exposure, in terms of my bond exposure, in terms of my other, right, meaning options or cash, to make sure, right, that if I'm going to reconfigure, I'm reconfiguring based on what I would like it to be. And if it's different than I would like it to be, then I know I have to take action. Second step for me would be, risk management wise, always start obviously with the largest position first. That should go without saying. So what is the most important thing to your portfolio performance? So paying attention to and keeping tabs on the largest position and its most recent movement, project some potential areas of support resistance in the short term, and then have an action plan. You want to trim some, right? Figure out where you would like to do that. If you already have a trailing stop on it or stop loss, trail it up. Make sure that you are becoming a more aggressive risk manager in in a bull market circumstance, a few stones away from all-time highs. I mean, that's kind of how I would be thinking about it. From the perspective of taxes, naturally the repositioning effect is going to matter. So if you're getting rid of a bunch of stuff and then you're going to reposition, be aware of the wash sale rules, right? Remember that the IRS looks not only at the exact same position as the wash sale potential, but also at similar investments, right? So there is a gray area there, and you really want to have that ironed out, appropriately according to plan. Hopefully, you're going to consult somebody who is well versed in that world, right? Not just H&R Block tax preparer, but someone who understands the true nature of wash sale rules and their complexities. Rob, your thoughts there, sir?
Yeah, the good news if you're self-directed is you get to assign the priority. So I think maybe let's think of an example of what some bigger institutions like pension funds do. a lot of them will rebalance quarterly, no matter what. So they have these guidelines of what their allocation is supposed to be. And they're not looking like, Constantine's got a chart of SPY right now. They're not looking at charts to make decisions. They're just looking at how much percentage is allocated. And then based off the performance over the past quarter, how has that allocation changed? So do you have outperformance in certain sectors of equities? Do you have outperformance in different asset classes like equities versus fixed income? And at the end of the quarter, no matter what, they will reallocate to their set targets. So that's one technique bigger money uses, and you can decide if that's something you want to do, right? If you have significant outperformance, so say you started at, say, 60-40 stocks and bonds, and stocks way outperformed, well, now they represent a much larger percentage of your portfolio. So in that case, you would typically trim some stock and reallocate to fixed income. But if you're a retail, you can do whatever you want. Now, I'm a chart-based trader, so I would look at charts and say, is there any reason to sell here based off the chart? So I know it's kind of a non-answer, but you actually need to pick. Now, the cleaner trades are going to be in your tax-deferred accounts because there's no tax consequence for shuffling the money around there. So in a way, that's the simpler decision to make. But if you have overlapping exposure in brokerage accounts that are taxable and tax sheltered, perhaps that could come into play. So hopefully that helps. Like, nobody can tell you what the right sequence is for you. You have to kind of decide and place emphasis. Now, as far as being prepared, like for instance, if you have the same position in multiple accounts and you have set targets, I think that's where account management, things like stops and limit orders, if you have set targets, to try to manage some of the mechanics of actually implementing your strategy so it's not overwhelming. Hopefully that helps. We have a lot of tools where you can kind of see where your exposure has changed. But I would create a game plan, like literally, like start drafting something, writing it down, and then see how it works over time. And you can obviously tweak your game plan. And as a retail trader, you can decide at any moment, I want to stick to it, or you can make the discretionary judgment to adjust that game plan as you see fit. All right.
Rob, and while you're talking, I'm just showing the tool where it is, right? Obviously, if you're starting at accounts and trade, depending on your screen real estate size, what you're looking for is that analysis tab to appear. So you want to select all accounts tab in the top left, and then you're looking for the analysis tab to be here. If it's not, click on the drop down for more and go to that spot, right? And then from there, really dissect the stock versus bonds if you own any individual bonds at the moment. Remember, if they're bond funds, right, like mutual funds or sectors, that would appear under different tabs here, right? Fidelity does a pretty, in my opinion, right, a very good job. By the way, it doesn't only have to be Fidelity accounts. You can actually add accounts from an outside institution as well, right, to this whole mix, which is a pretty grand tool. And then you're looking at it through the prism of the Dow Jones Total Market Index, which for the sake of comparison is the Russell 3000 index, which is all small caps, all mid caps, and all large caps. And kind of tells you what the index weighting is versus your own account weighting at the moment. And then you can look at it in dollar terms and percent terms. And what I love about this as well, Rob, is that if it is a mutual fund, right, or fund of funds, for example, something really complex with a lot of layers on it, Fidelity goes in there into the current holdings and it breaks it down. So let's say we're looking at this, First Quantum Minerals Fund. So how much is in materials, right? how much is in something else is going to be broken down. How about contra fund? Well, in dollars, this amount is in staples, this in energy, this is industrial, so forth and so on. And you can look at it in percentage terms as well. Export the data into Excel, play around with it. If you're an Excel or CSV geek, I certainly do that quite a bit for my own portfolio. So really nice tool
Yeah,
to
and
help you gauge where you stand. Yeah.
it does come down to conceptually how you're approaching your account. Me, I'm a chart-based and primarily trend-based trader. So if something's been in a sturdy uptrend and that trend is intact, technically for me, why would I sell it? So if you had outperformance in, say, stocks or a certain sector in stocks, you might be wondering, why the heck would I sell anything? Like, that's where my money's coming from. But the concept being is that you're not going to always get the same outperformance sector to sector or asset class to asset class over longer periods of time. So you're trying to kind of, in a way, buy low, sell high, and try to smooth out the returns over time as you're building wealth, obviously. Okay, hopefully that.
Rob, very quickly while we're on this Fidelity.com gear here. So there was a few questions about the options approval level where you can find out about this stuff. So where you're going to be going is accounts and trade, account features, and then under account features, look for brokerage options. So clicking on that will tell you what level you're approved for right now. There are currently 3 tiers. The system got changed up a little bit. Tier 1, Tier 2, Tier 3. Tier 1 allows you to do cash secured puts, covered calls, and the purchase of calls and puts. Tier 2 allows you to do spreads. Tier 3 allows you to do nakeds, right? So that's where you would find it under account features, options, and see what tier you're currently approved for. If you've just recently applied, and it will tell you, like, if it's pending, it's pending. If it's not,
Be mindful, certain levels do need like margin is required for spreads and shorting naked options, things like that. Okay. All right, let's get to something more specific. Eric's asking, what is going on with AAL? Huge downside volume yesterday. Can you bring up a chart, Constantine? So this is the life of trading and investing in individual stocks. It's not just stuff that's directly on the calendar, folks. I believe this company pre-announced.
Yeah.
And it was not good. Now, this kind of brought down some of the other ones, but some of the other airlines have been telling a different story. But anytime you see kind of a move that breaks the chart, it's a lot of times it's catalyst driven. So hopefully that explains it. Constantine, can you show them the news tool on, say, Active Trader Pro? So anytime you see a lot of times it's something like earnings that's known to be coming, but other things that could hit out of the blue are headlines, analyst upgrade, downgrades, things like that. But this was definitely catalyst driven. So if you're ever wondering, always just check the news. And in this case, very specific concerns about the future.
There are obviously a ton of upgrades, downgrades based on that news, but things like this matter. Cutting growth capacity in the second half of the year among the series of changes that includes departure of the chief commercial officer, right? So if you want to get details, that's where it would be. If you're a Fidelity.com user, Trading Dashboard is a great tool for finding maybe news alongside your chart as well. So that would be over here. You can see similar sort of structure on the right-hand side or in the bottom, depending on how you have this thing configured.
Yeah, let's connect this back to the first question, right?
Yeah.
So imagine you're managing your accounts and you had airline exposure, or specifically this one. So it's coming up on the end of May. Say you were somebody who normally adjusts things every quarter, and then you see something like this. Do you do anything? Like, are you compelled to act now? Those are the types of decisions you can make as a self-directed trader, right? Certainly for me, when you get something like this, where a lot of fundamental decision makers have gotten new information, You can see those upgrades and downgrades, things like that. Do you need to do anything? And this also bodes perhaps for diversification. So instead of owning one airline, perhaps you own some type of ETF or fund that invests in the airline sector so that one kind of struggling company doesn't sink the whole investment, right? So this is the risk of individual stock picking. But anytime you see something like this, 99% of the time, there is some catalyst a lot of times that triggers it. Okay.
Rob, just doing a little bit of analysis here from the volume profile and let's say an anchored volume weighted average price perspective, right? So, what you are, let me see, VWAP anchor. Let's go ahead and see what has been the average price since the low back during the pandemic, right? I mean, when we thought that these businesses are just going to be closed for a very, very long time, right? Or potentially never reopen. I mean, that's how dire the circumstance was at the time. No one was flying, that's for sure. So it's certainly below the anchored volume weighted average price from the lowest point that it's been in 2020. And you would notice that on several occasions that actually acted as a level of relative resistance in the short term. Now it's testing 11.5, 11.40, which was the lowest point in October of 23. Remember that was the spot where the market bottomed last year. So it's right back to the scene of the crime. And I would argue, Rob, that if you're evaluating it from this time frame's perspective, if it loses this low of, let's say, 11, and a tail, I mean, what's the obvious next potential level that it's going to be going to? It's hammering right through value areas like knife through butter. So to me, 8.5 to 9 is certainly a possibility if it doesn't hold up here, right? So the bulls need to step up. I know that it's a massive move down, and that's probably not what bulls in this name would like to hear, but this is a very dangerous spot for this chart for sure.
Yeah, Kanzi, can you bring up Delta, DAL?
You got it, sir.
So the chart looks quite different, right? So this is what fundamental decision makers make. If I want airline exposure, which one? So that's probably what's going on with some of these. We're seeing it all across the market. The market is picking winners and losers. The companies that are approving it, their stock prices are doing pretty well. The ones that are disappointing, their stock prices are getting absolutely wrecked. And overall, we're seeing the overall indices hold up, but it's not really this like a lot of this universal rally. It's the strong ones are getting strong and the weaker ones are getting weak type of thing. So that's something to consider here. Here's a great question from Robert. Short interest, how to evaluate and apply to a trading strategy or discussion. Now, short interest is basically just how many short shares are being held. Now, I believe it's updated like twice a month or something. So some traders will look at this if there's kind of extreme levels of shorting. Now, typically you get situations where usually it's where something's fundamentally in question with the company or weak. So there's a lot of bears in there thinking the stock is going to go down. If any good news comes out, I mean, we saw this a couple of weeks ago with some of the meme stocks, right? It was some random post on the internet. Can you bring up GME? Nothing fundamentally changed with the company. There was no news. It was just a post from that. I forget what his name is. And can you bring up a chart? And the thing skyrocketed. Now, part of the reason why it skyrocketed is because there's so many people short this thing. Then you add in derivatives and you get these explosions. Can you go back to, what is it, a month? And you can see. Now, you notice it didn't last. So some traders will look at the amount of short interest as kind of like fuel if there's some catalyst. It literally could be nothing, a post on the internet, nothing to do with the company. And can you click on, say, 10 years, Constantine, or 5 years? And we've seen this happen repeatedly. Can you take off the scaling?
I'm just keeping it on logarithmic just to keep it in proportional idea of what's actually transpiring. I mean, it's only fair if we do that because the bottom is in pennies and the upper end, right, is in dozens of dollars. So I just wanted to keep the logarithmic scale on it. But yeah, you get the point. There's been plenty of spikes that reverse. But the idea again, Rob, to your earlier point, I mean, is it something that you need to monitor? I think you do because if price action starts to break through levels of resistance for whatever reason, right? If there is appreciation of price above areas of prior resistance that the stock struggled up against, short covering potential for fuel is certainly there, right? So the larger the short interest, the grander the potential for the buy-in fuel. And those are going to be buyers that are very likely very mechanical about it, right? It's hard to be short stocks in general because you're betting on the fact that the stock is going out of business, or the company is going out of business, or the company is going to continuously suffer from deterioration of price. So most short traders, at least who do it in decent or large size, are very much fundamentally driven, right?
Yeah, KV, can you bring
In
up
individual stocks.
loose LCID?
Yeah.
Now, folks, I am not picking on this stock. It's just the first thing that comes to mind of a chart that's really struggling. Okay. So the whole EV space has kind of fallen out of favor, right? Even Tesla, which is the best of them, its stock chart has been struggling. And now we're looking at a company like Lucid. So look at this, right? It looks like it's in trouble. Like that's why the chart looks like this.
But
But if
exactly. But how much can you really make, right? If you're short
exactly
the stock.
like
Yeah.
so there's probably a lot of people thinking like maybe this thing is just going to go away eventually. What could happen? Now again, I'm just talking hypothetically. Sometimes companies get a lifeline, turn it around. Like the valuation gets so compelling, right? The entire sector, right, comes back into favor. Kind of rising tide lifts all boats. It might get acquired. It doesn't matter. What happens if there's a lot of short interest is anybody who's short is going to try to cover. Folks, raise your hand if you remember when some of the regional banks went into trouble. What happened to them? They stopped trading.
Yeah.
So even though theoretically, if a company goes away, your short should win. It's not that straightforward. If you can't close your trade, you're stuck in no man's land. So a lot of people might just mechanically try to close just to get out of there. And that's how you can see these abrupt rises. And that's the nickname, the short squeeze. Raise your hand if you've heard that term before. The squeeze means it's not buying necessarily because it's just bulls stampeding. It's the bears trying to get the heck out of there. And as the price keeps rising, KV, as you mentioned, bears that are managing risk are forced to buy, sending it higher. And you can see the extreme version in that GME chart. Okay, so hopefully that helps. Now,
Rob, and
yeah,
exactly to the point, right? I mean, look, if it doesn't mean that you can't make money being short Lucid from here. If it goes out of business, you can certainly make money. But the point is that it's $2.80. So that's the most you can make by being short a share of Lucid. But you can lose exponentially more. And that's the reason why a stock's trading in single digits is considered by the vast majority of institutional investors as an option contract, right? Because it's trading for basically an options value. So
okay.
so if you trade options and you understand what I mean by saying that, right? Like you can create a strategy in a risk defined fashion by being long a put or long a call for substantially less capital that it requires or necessitates for you to keep a stock position on, right? Don't be on the short side of that equation, preferably. And if you are on the short side of that equation, be on the short side of that equation in a risk capped way, right? So utilize, hopefully, options around the position that you were long or short to make sure you're not blown out.
Yeah, it's one of those things, like if you're trying to short some, if you are a bear, is it good to know if there's massive short interest? That could, especially on something that's repeatedly shown it, like some of these meme stocks, I would argue absolutely yes. Would you want to short something like that at all, even if you think it's going down, given you never know when something could trigger a response?
Rob,
So,
in addition,
yeah, while you're bringing this up, let's kind of combine questions. Larry's asking about the put call ratio, and basically, can it be used as part of a strategy? So, I'm an options trader, and I'll tell you this: I personally do not care what the put call ratio is. I don't care what other traders are doing. I only care what I'm doing. Your trade will essentially be defined primarily by what the underlying does. Having said that, options do and many times come into play, especially as we get closer to expiration. If there's huge positioning, right, especially at various strikes. So you can get this move as stocks move up or down because of the derivatives positioning that's out there, right? So if you think about what's going on here is when you buy or sell an option, somebody's on the other side of that trade, and it's typically a market maker. And the market maker is not betting against you, they're just trying to provide liquidity. So as soon as they take on that position, they're typically using some type of offsetting position to neutralize their risk. So if you have, say, a ton of people, retail, institutional, say, buying call options, well, that means the market makers are shorting those options. And what they need to do to offset the risk in case it goes up is buy the stock. So that's why you can see these moves that kind of just look like like whatever direction it's going, up or down, it looks like it just keeps pressing, because as the momentum continues, you have this kind of mechanical feedback loop that keeps it going a lot of times until it gets to the point where it stops. Now, KV, I know you spend a lot more time on this type of topic, so why don't you chime in here?
yeah, Rob, absolutely. Stephen is mentioning the same thing, right? The gamma squeeze situation. I mean, effectively, gamma is the first derivative of delta, but like let's use Lucid as an example. And to Robert's earlier point, the market maker's job is to provide liquidity. And trust me, like I wish I could buy, a true current um currently involved serious market maker a beer, right? Because I have a ton of questions to ask them, whether it's he or she, it doesn't really matter to me. Because, I imagine and I understand how it works, and I know that certain actions take place, but I don't know exactly how they've been doing, right? So do I envy someone who is making markets in GME options? Not at all. Did I envy someone who was making markets in AMC options? Not at all. I mean, in fact, I can't imagine, right, that during those squeezes they feel really good, because of the fact that they're basically stuck in their own gamma squeeze situation. They're trying to manage that position. So let me explain. So let's say that we're looking at the July expiration Lucid, you know, $3 strike call options. All of a sudden, everybody decides that they want to be buyers of them. Well, right now, the bid is 22 cents. The offer is 25 cents. And that option has a delta of 43. So if a buyer of this option comes in and bids 25 cents and gets a fill, then the dealer, the market maker, has negative 43 deltas, right? What does that mean? That means they go into the market and they buy 43 shares of stock to offset their delta exposure. So they're delta neutral and they have some option-centric risks, right? They have gamma exposure, they have vega and theta. The gamma portion is how delta goes up or down depending on the movement of the security. So imagine a circumstance that everyone is buying threes and the dealers are selling them these threes, and the price of those threes keeps going up, right, as the demand rises. But then the following day, the stock actually goes to 3.5 or to 4. Well, that delta grows massively by the amount of gamma. And so the dealer consistently is having to basically chase the stock higher in order to be delta neutral, losing money effectively on their short delta position that is growing through the overnight cycle or the pre-market action that they're having to then chase. So it's a very difficult job. And, in order to do it well, in order to be able to do it profitably, week in, week out, month in, month out, year in, year out, you have to be extraordinarily gifted. You have to have amazing technology in place. And that is the only reason why I can say that there is effectively 4 market making firms that own close to 90% of the options market world at the moment, right? I mean, they share the pie. Two of them probably share 80%, and then the remainder have the rest. It's not because that, we live in an oligopoly world or a monopoly world. It's because this business is extraordinarily difficult, and if you have to do it well without having to hang up your gloves, the investment in technology has to be absolutely immense. Let's see. What else can we answer?
There's a question here from Anonymous. How do I add option spreads to a watch list? So unfortunately, you can only add individual tickers. However, if you want to keep track of a multi-leg trade, KV, can you bring up the profit loss calculator? What you can do here is, if you already have the trade, just type in the ticker symbol at the top. And if you have more than one account, select the correct account down below. If you already have the trade, it will appear in this P&L tool. It's typically used for modeling, but you can also use it to kind of observe and keep track of it. But you can also add simulated trades, which is what I assume you would want to add something to a watch list for. All right, so KV is building out something right here. It looks just like a trade ticket. It's not a trade though. You're just putting in your legs, putting in your prices, and then you can click apply, and it will stay in here until you delete it. So you can kind of keep an eye on it if you want to kind of, if you're like kind of paper trading, so to speak, to see how a strategy would have performed. And you can even click the little caret at the end to expand the individual legs. And of course, the primary use of this tool is to model what could it look like in some hypothetical future, putting in a price of the security, a date, and an expected change in volatility. Okay. Let's see here. Oh yeah, somebody's saying that the poster's name was Roaring Kitty. Yeah, I knew it was I knew it was something like that. Yeah, like folks, this is a perfect example of no matter what analysis you do of why you think a company stock should be trading for a certain price, fundamentals, technicals. When you see a post by some person on the internet, has nothing to do with anything about a company, and it can ignite movement in a stock, that just proves to you that a stock is simply what somebody's willing to pay for it at any split second in time. And we saw that change quite dramatically, both to the upside and then back down. Now, usually you don't get that type of response in stocks, but ever since the meme craze, it seems to be having quite an impact, right? So that's one of the things that I'm mindful of is, how has the market dynamics changed since I started doing this about 30 years ago, right? Advancements in technology, changes in, the cost of trading. So while any retail trader individually has basically no impact, even if you're a big one, it's like walking up to the ocean and throwing in a quarter. Collectively, can they have an impact? Absolutely. Even if it's just to light the match that sets the fire, that draws in bigger money and algorithms, and of course, we just talked about the impact of derivatives. So just manage risk, folks. Like, think about that GME. If you've seen repeatedly over the past couple of years that at any moment some random catalyst could send the stock up 100, 200%, who's shorting that thing without some risk management strategy, as constantly talked about? I mean, I wouldn't be able to sleep. At the same time, it's in an industry where technology has changed. I'm a gamer when I'm not trading. Like, I can't, all my favorite stores when I was younger that I used to go to, they're basically all gone, except for GameStop, because everybody buys most of their games online now. So that's why fundamentally the stock is struggling. And it kind of, the management is trying to, obviously change the fortunes of the company. But we're seeing how that plays out. So perhaps that's why a lot of these bursts higher can't sustain, is because there's not enough people willing to support the share prices once it pops, because the fundamentals are in question. So it's not like it's some easy thing to be a bull. Anybody who bought at that apex might be wondering, what the heck did I just do? They also have to have disciplined exit strategy. Or, like me, you can look at this and say, is this something I'd want to trade or invest in at all? And once again, every one of you in the audience gets to make that decision for yourself. Nobody can tell you this is right or wrong for me. Just understand what the situation is, and it can change in the blink of an eye. Just manage risk. Time frame, short, time frame, long, bull, bear. Every successful investor has risk management as the core principle of every decision they make. You make a mistake one time, and that could be the big mistake. Okay.
Rob, very,
Yeah.
very quickly here, just wanted to hop in. I mean, look, I know this is not an options class, right? But if you are trading the underlying, even if you're not an options trader, being aware of implied volatility expectations in a stock could be immensely helpful, right? I mean, yes, you could look at price targets by analysts, and you can say, where is this? Where are they expecting the stock to be in 12 months? Because they put out price targets. But those are all hypothetical, right? Those are sell side analysts trying to sell their research, the buy side analysts who are making the purchases. The options market is actually telling you what current market participants in today's reality are expecting the ranges for stocks to be. So the options market is really where the rubber meets the road from the perspective of expectations and the distribution of outcomes that are possible or potential for a security, right? So a ton of information from this. I'll get off my soapbox, but point is, when you see an implied volatility in a stock in triple digits, well, if it's supposed to represent one standard deviation of occurrences around a normal distribution, then you know that there is a clear bias to this thing, right? There's a clear risk or bias to this thing. What is the risk? Well, stock can only go down 100%. So how does it make sense that a one standard deviation expectation of 1 month options are 175%? Two standard deviations at 350%. Well, because it has that unlimited upside, right? So when you deal with a triple digit vol, at least hopefully you recognize which side, right? There is a substantial bias towards, and you're playing it safely, and you're playing it in a way that is informed more than someone who doesn't pay attention to this stuff at all. Rob, there were, a few questions about the call put ratio. I just wanted to say this, folks. Do we look at it do you want to be aware of it sort of like where it is right now relative to the 90-day average? I mean, sure, right? You want to understand what the normal dynamic is like based on the open interest that is currently outstanding across all expirations. But it doesn't tell you what is actually going on because you don't know the flow. You don't know if they're buying those puts or selling them. Same thing with calls. That's why you have to look deeper, right? You have to look at net deltas. You have to look at transactions that are going off on the ask price or through the ask in very large volume or through the bid and very large volume. So you have to dig in deeper. And we coach sessions how to look under the hood to figure out maybe what is going on. But like you look at spies, for example, and for as long as I've been a follower of spiders or SPX, 1.25 to 1.5 put to call ratio is normal for this thing. Does it mean that people are always bearish S&P? Obviously not, right? They just use options in the S&P 500 in a particular way.
Yeah, usually with hedging. Like
Exactly right.
so you don't want to compare, apples to oranges, right? But do a lot of traders look at what's normal for this particular situation, this particular security? And then are there outliers? Now, in the end, it's just another piece of information. You can decide if that's useful to you before making a decision. Now, if you're trying to use it to make a guess, just like everything else, the stock or the market's either going to go up or down. Once something happens, can you look back and say, oh, well, look at how many calls there were? It's always something you look back and craft a story after it's happened. So let's
Rob,
actually
while I'm on
let's
this option chain, there was a question about how options expiration dates are determined. Just wanted to throw it out there. Look, there is a calendar of expiration cycles that you can pull from the Options Industry Council, OIC. So you can go in there and say options expiration calendar, or options expiration cycle, OIC, Oscar India Charlie, and it will give it to you. But the idea is very simple. In certain products, there are daily expirations. SPY is a great example of that. For SPY, there is going to be 5 daily expirations at any given time. There's going to be 5 consecutive weeklies at any given time. There are going to be monthlies, which is the third Friday of every month. They're going to be quarterlies, and then they're going to be leaps. So if you want to see what the most crowded expiration cycle calendar looks like, you pull up SPY or you pull up SPX, right? The less popular products will adhere to that options industry council cycle that I was talking about. So does it have weeklies? Yes. Does it have monthlies? Yes. Does it have quarterlies? No. So it has like June and July, but doesn't have August. Doesn't have September, goes straight to October. As soon as June is out, which is coming up, right? They're going to very likely add August to the back end. So there is that cycle of when those new expirations are coming for stuff that doesn't trade very often or frequently. But if it's something liquid, there's very likely going to be the weekly availability, which is 5 expanded weeklies, which is 5 consecutive weeks in a row, and then the 3 months forward plus some leaps on the board. And look, if you're an S&P 500 trader, you know that VOO is trying to do the same thing as SPY. It's trying to do the same thing as IVV. We often use this example. Which one would you prefer to share or trade options in? To me, it's obvious. They all have low tracking error, right? If you're investing in an exchange traded fund and you're buying it for the long-term hold, you care about the tracking error, you care about the expense ratio. Those things matter. liquidity matters. But for an options trader, where's the action? This thing traded 15 million contracts versus this thing traded 1.5 million contracts, and it has nowhere near the amount of expirations availability. I know what my weapon of choice is going to be. It should be obvious, right? So look for the most liquid underlying when it comes to options trading. That's where the expirations are going to be.
All right, let me steal the screen. Somebody's asking, how do we use triangles and pennants? So and then somebody else also asking, how do we enter when something's been on a tear, whether it's a stock or the market? So you try to address both those questions at the same time. So here's Costco. They report earnings after the bell today. So I thought this was a good example to use. So look at the run before the dive, and then look at this price action. Now, if you attend our briefings, this was one we had been watching for months and months while this kept staying in this channel until right here. Now, did it have to go up after that? No. But charting is not about predicting the future. It's about making a decision. So if you see this converging pattern and then you see that pattern break, as a sequence of decisions, what should you have done if you were a bear? You should have closed and reevaluated. And if you're a bull, that's what you're waiting for. So whether it's a triangle, whether it's a rectangle, what you're trying to identify is the trigger point where you're looking to see what the response is. So I'm going to switch, I'll switch over to UNH. And let's go to a 5-year perspective. Now I'm going to switch this to weekly so it kind of stands out more exactly kind of what's been happening to this thing for years. Let me get rid of these grid lines. Now, if you're an investor, it's basically in the exact same place. It's not very exciting, but it's also not the worst thing in the world either. If you're a trader, you might be placing trades based on, hey, maybe it's just going to stay in this range until proven otherwise. Now, it tried to break out to the top several times, and it was in jeopardy of falling out of the bottom just recently until it snapped back. So there's probably a lot of bulls that were closing here or about to close if it didn't fight back quickly, and it happened to do so. There's probably a lot of bears who entered on this break. What should they have done when it didn't follow through? Cover. That's the difference between using chart patterns, trend lines, indicators. That's the difference between using them for decision making versus prediction. You still have to guess what you think is going to happen, but then you need to respond to what happens next. Constantine, you pointed this one out as it was happening, right? NVIDIA, not what's happening right now, but way back here, it was you and I together in a class. Somebody in the audience mentioned NVIDIA's finally breaking through 500. And what did you mention? Said, if you're a bull, is this the time? Enter your bullish position, and then you can close it if it falls back into the box, invalidating the signal. What did I say that day, Kate? It wasn't for the bulls. Like, if you're a bear, do you need to be short right now when it just broke through? And anybody who didn't cover, that's pretty painful. Hopefully that helps. Triangles, rectangles doesn't matter. That's how you use the chart patterns.
Rob,
Now,
if you don't mind bringing up Tesla right now, because it is kind of, we could say coiling, going sideways, right, in this very congested area. And it's right up, underneath the 100-day simple moving average, acting as a level of resistance. Look, it doesn't have to break right away or shortly, but eventually it will. And so what you're looking for is that release, or at the very least, the initial release. Is there follow through in one direction or the other? And if you already have a position, you know what you want that direction to be, right? So have a plan on what you're going to do if it does the opposite of your expectations. Look at the options markets, how cheap or expensive the options are. Maybe it's better to be doing something in the options markets in the risk-defined way, right? Versus having a stock position with a lot of capital committed to it where stock doesn't even pay a dividend, right? So, this is a kind of a current pattern that I'm very closely watching and eyeing, and this is a very volatile security. So it could be a good example of a current coiling spring in the symmetry up and down within a very tight range. Eventually it will go. Which way? We're going to find out together.
Yeah, and there's a potential catalyst, right? I believe they're in like the vote for Mr. Musk's pay, or the revote rather for Mr. Musk's pay package. There's constant headlines surrounding this company and the EV space and also AI. It could be anything. In the end, the chart-based trader will respect whatever happens on the chart and be ready to make a decision, especially if you pick the wrong side. That's the more important time to make the decision, is if I guess wrong, where am I going to manage risk? And I think that's the part that most people leave out. They spend all their time looking at charts trying to predict which way it's going to break. But if they pick the wrong side, they just don't close. Like, that's how the small losses become big ones. And they become big in a hurry when you have a volatile stock. Okay. All right, let's try to cover as many questions as possible. Gene
Yes,
was
Rob,
looking at.
absolutely. And you know that I have to jump out right on the
Right.
hour here. Brett was asking, where can I easily see a P&L in a closed position? So, Rob, if I had to do it, and I do it, every day, in Active Trader Pro, going to your closed positions in Active Trader Pro, not on Fidelity.com, but here, and saying, hey, do I want to include the symbol? So if you're trading options and you're trading stock, if you have that symbol includes, and just type in the symbol that you're looking at and then giving it a time frame, right? This is probably one of the better tools that Fidelity has for close
You,
position evaluation in terms of
I want to
P&L.
say something. You see this last business day where you can quickly check the last trading days? That's my contribution. I asked them. I asked them every day for this thing for like a year. They finally added it. So if you're wondering how to quickly check what my P&L was the last trading day, just remember, squeaky wheel gets the grease. All right. So if you have any feedback for Active Trader Pro, especially when they launch the new version, just keep pestering them with feedback, and eventually they'll move it to the top of the list. Okay. So let's.
Rob, quickly, Arnold was asking the risk reward of YMAG ticker symbol. So Arnold, I took a look at it, never heard of it before. Yield Max ETF. Look, if you want to really consider this thing, like I obviously would recommend looking at the prospectus in detail and then setting up an appointment with one of the strategy desk people to say, are there any additional maybe blind signs that I haven't thought about already?
Folks,
These are very complex products because they very likely own stock in some shape or form and then sell options against that position, right? So
folks,
you really want to be aware of exactly what they're doing in that strategy and what the risks associated with that particular strategy could be.
let me do that. Let me do that. Let me ask you a question. Raise your hand if you've read the prospectus of an exchange traded product. Okay, there's over 100 people in here. Less than 10 have raised their hand, right? Now, obviously, it doesn't mean everybody's responded. There are so many exchange traded products, folks, now. If you have any doubt about what this product does, read the prospectus. And if you read something and you're like, I'm not quite sure I fully understand it, as Constantine mentioned, that's a great time to set an appointment with us just to make sure. There's risk in every product. I've seen countless articles about, oh, it's risk-free, right? Covers your downside. Folks, there is risk somewhere in there. If they've completely neutralized the risk, I think there's some products out there that do this. There's always the chance you don't make any money at all versus just being in like a money market fund. Like that's the risk, is opportunity cost. There's no free lunch out there. There's always a trade-off. So if you're looking at something and you don't see it, you need to keep looking for it.
Totally agree.
Okay.
Rob, that goes out to the SVOL product as well at Sierra Victory Oscar Lima. Arnold, if you're really interested in that one, like I mentioned, right, set up an appointment and we'll look at it in detail. Devil's always in the details. Um, Looking at things like obviously liquidity, right? So how many shares is trading? What is the depth of book? What size of a position are you thinking about trading? Is it $1,000 or $10,000, or is it 100 grand to 1 million, right? I mean, those things could be very important. So liquidity is first, tracking error, expense ratio, the details about rolling, exposure to the carry costs if there are futures involved, right? Um, what else? I mean, that comes to mind. Things like distributions. How often do they distribute income or values out of that fund? In other words, how much trading are they doing? And are they distributing things on the weekly or the monthly basis, right? That could potentially be taxable for you in a brokerage account. Things of that sort. There's a million things. But those usually are the ones that I go to first and think about.
Yeah, so let's address a couple like questions again, coming back to that. How does one enter the market when prices are as high as they currently are? And how, like using something like the 20 or the 50 day as a measure of trend and risk management. So here's Costco. Now, what you're seeing on this Costco chart is almost a repetition of what happened before its last earnings. And it reports earnings today. And when you see something like this, we have a nickname for it. It's price to perfection. Raise your hand if you've heard that term. It basically means it's setting a high bar for itself based off how the stock is traded. It's anticipating a good report. What happened before? It was pretty good, but it wasn't amazing. And it led to a correction. It broke trend. It survived, tested the same general area 3 times before breaking. Again, kind of a converging pattern. So not too dissimilar from the bigger break. If you're a bear, is that what the chart should look like? No, that's what the bulls want to see. And if you're a bull, what are you waiting for? Now we're on the doorstep of the next earnings. If you've had a position, what do? Is it worth the risk? It doesn't mean it can't go higher. It's just got to be good. If it is good, it could keep going up. If it isn't great, is this okay?
And Rob, I think since they reclassified Target into Staples now, just like Walmart, right? I mean, now we have two examples. So if you look at Walmart, that's what the bulls want to see happen, and the reaction, right, to the upside versus, Target, the exact opposite, kind of breaking trend and breaking down. So you have two examples of how it could potentially resolve. And Costco is no Walmart, and it's definitely no Target. So it's got its own thing going on, but it's in the same, consumer discretionary, consumer staples business at the moment. So you're gonna have to be thinking about those two that just went and the performance thereafter.
Yeah, KV, I know you got to run for an appointment. So if you got to drop out, it was a pleasure. I'll stick around for a few more minutes because I do think this is kind of a good thing to end on here. I know we didn't get to all the questions. So now let's look at the same concept. when something's incredibly strong, notice how it barely breaks its stride. Even right here, if we zoom in, you can see that it falters for a day right at the prior peak as it's trying to climb. I'll draw a horizontal line. Now, if you had a bearish mindset and you see that, it'd be very tempting to say, oh, it can't make a new high. But then it doesn't really follow through the next day. It kind of holds above its 5-day SMA just barely. That's what it had been doing before when it was stronger. Notice when there was a more significant pullback, kind of maybe went a little bit too far too fast, it breaks its short term, and in this case ends up going to the 20 SMA. After that earnings, you can see it initially tries to hold near its 50. So if you're wondering when to use the 20 or the 50 SMA line when deciding to sell, is you get to pick what your parameter for risk management is. Like what's enough of a break of trend where you feel it'd be better to close and reevaluate. There is no right line. We can see here that the 50, the green line, eventually broke, but the stock didn't collapse. It did hold above its 100-day, which is the purple line. Now, this one gave you a chance to get out. It's not always so easy when you have catalysts. The biggest one today was from last night, and this is Salesforce. And they had their first revenue miss in forever. And the stock is getting hammered, although looks like it's trying to stabilize. So let's go back in time here and say, what's the correct line to use? Well, if we zoom in here, so before this bigger decline happened, we can see that because it had gone sideways for quite a while here, the 20 and the 50 weren't that very far apart. So in a way, it would be a very similar risk parameter because everything was so clustered together. So hopefully that helps you understand that it's not always just a simple decision. If something's in a nice uptrend, then you can pick if there's a sizable gap between. But if you got something that's been going sideways for a while, a lot of times the moving averages kind of get into this traffic jam, I like to call it. And that in itself is a potential warning sign if it breaks to the downside. And this was a textbook example. In Salesforce's case, it tried to go sideways again. Notice the rejection of the 50 SMA on the attempt to rally. Right? You see it tries to break out of the consolidation and then stonewalls at this convergence of the 50 and the 100. And then, of course, it was bracing itself for the catalyst, and unfortunately, the catalyst was disappointing, and you're getting 1/5 of the share price gone in a day. We'll have to see how it shakes out. So again, don't necessarily think of one speed of the moving average is better than the other. Just think of it as a choice based off your time frame and your risk tolerance. As a last example, we'll look at the broader S&P because somebody mentioned when the market's this high. So this is what the daily looks like, but this is what the weekly looks like. So if you're a longer term investor, I just got back from time off, but before I left, the market had ended its historic run of the 5-week moving average. The next week it went to the 10, and then right before I left for my time off, it was right at the 20-week SMA. Right here. Things were looking pretty ugly. It's not about prediction, it's about planning. What I highlighted was during the pandemic recovery, when the market ran into trouble, the 20-week SMA is where the bulls took a stand. Okay. Where are we right now? Literally sitting right on the 5-week SMA on the doorstep of a major catalyst tomorrow in terms of the PCE inflation. So if the market's stronger and maybe the data cooperates tomorrow, technically this is roughly where the market should try to bounce. Is it going to? We don't know. So again, to answer your question, Gene, how do you enter when the prices are so high? The expectation has to be that they are going to go higher without stating the obvious. Let me lower the hands before we go. How many people are kind of waiting for a pullback before wanting to deploy new money? Okay, a ton of hands just shot up. A ton of hands. Okay, that's great. Now let's go back to this daily chart. I'm gonna ask the same question again, but I'm gonna highlight a specific time period. How many of you felt the same way when the market was here in the green circle? Basically, you kind of feel the same way you feel now. You're waiting for a pullback. Okay, and roughly the same number of hands went up. Okay, let me lower the hands again. And there's a point to this sequence of questions. How many of you that just raised your hands bought and entered positions, if this will cooperate here, in this box right here? And a ton of people raise their hands. So now we're at the same point as the green circle. What's the risk here? Well, one risk is it comes down. Catalyst, doesn't matter why. And if you enter here, you're going to be at some form of a loss. What's the other risk? What if it goes up? So you're waiting for a pullback, but it never really pulls back. So since we don't know which version we're going to get, you have to choose what your sequence of decisions is going to be. If you enter here, you have to say, I think there's some chance, right, that this can push higher from here. But what's the more important decision if you enter here? It's not if you buy. It's when are you going to sell it if it goes down? If you don't do anything and it goes up tomorrow and keeps going up, the worst thing that happens to you is nothing. The opportunity cost of not making that decision, but that's not the same type of risk. It is a risk, but not making money is very different than losing actual money. Okay? If the market's stronger, it shouldn't pull back much. And that would be the defining characteristic of bullish conditions. There's also a chance you could just stumble around here for a couple of weeks, couple of months, and you can kind of pick and choose your exits. And as long as it doesn't go down too much, if you're a long-term investor, no harm, no foul. So I'd encourage all of you that are wondering what I should do, don't make a singular decision. Consider scaling into your position. Add a little in case it goes up. If it keeps going up, maybe you can scale until your full position size. That way, if it goes down, you don't lose as much. And you can decide if you want to hang on to the initial position, add more. Hopefully that helps, folks. I know we didn't get to all the questions. We try to touch upon a wide variety of them. I'll be in the midday market briefing to kind of go over a couple of those symbols I had at the bottom. I think one last good example is Dell. Dell doesn't report until today, after the bell, but it's having a very volatile day. Could it be due to the fact that it was launching higher ahead of the catalyst? This report better be good, folks. It can't be some disappointing thing like Salesforce when you have price action like this leading into it. That's the risk of the catalyst. The chart just shows us what has happened. We don't know what the impact of all those future decisions will be, especially when fundamental decision makers get new information like earnings, or when you get pre-announcements like the AAL situation, okay? The charts can only help you so much because the charts can't predict the future. All right. Gene, maybe one more MNDR. You said, is this a recent pump and dump? Well, we only know that once we look back at the price action, right? Now, we want to be very careful when we use industry kind of terminology and slang. Pump and dump is a nickname for basically fraud, typically associated with penny stocks, where usually there's some type of like unsubstantiated or untruthful rumor where they're specifically trying to pump up a share price so they can sell the shares, but it's not just price action. It's actually like a form of manipulation. So we kind of casually use that name whenever we see something launch higher and then sell off. And if that's what you're referring to, then, well, that's what it looks like the price action did. Okay. Now, when you see something like this, just like we saw on the airline, like the first thing I would check for if I'm just trying to do some kind of detective work is, was there a catalyst? All right. But certainly, like, it's certainly alarming to see something like that, right? Like when you have something trading at 20 something dollars and one day it basically just disintegrates. And hopefully this shows you in the audience, you never know what can happen. Now, would this happen to something like Apple? Probably not, right? Unless something dramatic happens. But when you have some company, you never know what can occur. And here's a perfect example. Even if there is a legitimate reason why this went up and then came down, it doesn't change what happened to anybody who held on here and still has it. Like there is no empty space in your account balances. Oh, here's why it plummeted. It's just the amount of shares you have and the price per share. Okay. So Gene, yeah, certainly it looks kind of strange and would certainly warrant further investigation. That's if you're even interested in this thing. Okay. All right, folks, we'll call it there. I'll be back in 10 minutes in the midday briefing. Hopefully these sessions helped. Again, there's so many questions. We couldn't get to all of them. I apologize, but try to cover as many as possible. All right. We host these sessions regularly, usually with different hosts, so you can kind of get a different range of perspectives and not necessarily opinions, but I guess just perspectives and approach. So we'll see what happens today, folks, right? Hopefully I'll see a lot of you in about 15 minutes. For those of you that can't attend, brace yourselves. They have some big earnings tonight. Okay, we got Costco, we got Dell, Zscaler, I think MongoDB, Marvell, Ulta, some pretty widely followed companies. And then buckle up for inflation data tomorrow morning that could very well determine the trajectory of the market for the next couple % higher or lower. All right, take care, everybody, and hopefully you'll see a bunch of you here in the midday briefing.